Booking stock has risen over 44% in the past year, and today we'll be looking at a clear market leader with great pricing power. Is this possibly the perfect stock? Because it has solid fundamental and efficiency ratios, and it has very high brand recognition and rising market demand. So today we'll be looking at Booking Holdings, an online travel agency company. Now, in their annual report, they say that they provide online travel reservation services, which facilitate online travel purchases between travel services providers and travelers. Now, they offer these services through 5 primary brands. Now, they have Booking.com, which I'm sure most of you know. They have Priceline, Agoda, Kayak, and OpenTable. They believe that global travel bookings will generally continue to grow and shift from offline methods to online channels. So they basically provide a solution from instead of going webpage to webpage from different hotels comparing prices, they put everything in the same page and you're able to reserve directly from them, which honestly makes the customer experience so much better and you're able to do it a lot faster and find the perfect holiday for you, whereas it would take so much time in the other way. Now, the strategy that they define can be broken into 4 different parts. The first one is that they want to leverage technology to provide the best experience to customers. Then they want to partner with travel service providers and restaurants to their mutual benefit. The third one is that they want to operate multiple brands that collaborate with each other, and they're already doing so with the 5 brands that they have right now. And number 4 is to invest in profitable and sustainable growth. Now, when we look at their financial analysis, Booking honestly looks great. They have a very high return on capital employed of 23%, which is amazing to see. They have a lower than what we wanted interest coverage ratio of 6 times, since the threshold that we usually have in this channel is 10 times, but this is okay since they're extremely consistent with their profits. Then they have a very solid cash conversion of 131%, an insane profit margin of 97% because their only cost of goods sold is their cost of running their websites. And then they have an operating margin of 26%, which is again above our threshold of 15%. Now, just look at this growth. They've gone from 10 billion to over 20 billion in only 3 years, as the revenue, gross profit, and net income have gone up every single quarter. Well, almost every single one, because as you can see, net income actually declined in December 2023. However, their revenue has grown by 21% year over year. Now, when looking at their efficiency ratios, these are incredible. We do have to remember that this is a logarithmic scale. So for example, the return on equity, we should not take a look at, and it's actually very biased, since you can see that the return on equity is not appearing on December 2023 and March 2024. And this is because their equity actually went negative. As we can see right here, in the last year, their equity has gone negative, meaning that their total liabilities are actually above their total assets. Now, to me, I've said it a lot of times in this channel, to me, this is a big red flag, because we can see that from 2014 all the way up to now, their total liabilities have been increasing at a way faster rate than total assets. But when we look at their fundamental analysis, this company looks amazing, and they score a 7 out of 8, because they have very low liability risk, as we have discussed in one of the previous slides. Then they're extremely consistent in the cash flows that they generate, and they're able to grow organically these free cash flows, all thanks to their incredibly fast-paced revenue growth, which is of course organic, meaning that they do not rely on M&A in order to increase these revenues. They can grow them without acquiring new companies, just by increasing the reach of their platforms. Now, this company offers share buybacks, which is extremely positive, as this does not dilute the shareholder, but it does quite the opposite. It increases the value of your shares. And now finally, the most important ones, this company has incredible pricing power, and they have a very big existing moat or competitive advantage. Because, for example, I use Booking a lot of the time when I reserve my holidays, and honestly, whenever I'm going to book a trip, I only look at Booking and Airbnb. I believe they're the best websites. I used to prefer more Airbnb, but now that Booking is actually offering more housing, apartments, villas, and every other kind of alternative to your holidays, they're actually even more useful than Airbnb, because in Airbnb you don't have hotels, whether in Booking you can actually compare everything at once. But the fact that I'm saying is that this existing moat is that they have such a wide platform of clients and such a wide base of offerings that it creates the perfect combination where if you want to book a holiday, you will probably go to the place that is comparing the majority of hotels you can find, which is most of the time going to be Booking. And then they have such a good pricing power because they're a platform and they offer a unique service. So if you are the owner of a hotel, you will pay vast amounts of money just for your hotel to be advertised in Booking, since it can get you so many reservations that you wouldn't get without Booking. And now the only thing that I didn't like from them is that they don't have a solid balance sheet, and this is basically because of the red flag I mentioned earlier, which is that they have negative equity. Now, this company skyrocketed in December 2020. The main reason for this is that, first of all, it was COVID year, it was 2020, and as we can see from the yellow line, their EPS were extremely low, which caused their price to earnings ratio to skyrocket. And now if we can see right now, their price to earnings is at 28 times, which has more or less been in line with the previous years. Now, when we look at their free cash flow yield, it's a 5.4%, which is a lot higher than the long-term inflation rate of 3%, meaning that this stock may be undervalued at current prices. And the main risks and possible challenges I saw is, first of all, the worsening competitive landscape. Because this is such a profitable industry, there are so many competitors emerging every single day with unique value propositions, unique technologies, softwares, comparison websites, and everything that are facilitating the process of reserving holidays, for example. And Booking will have to stay one step ahead of the game in order to maintain their market leader status. Now, the only other risk and possible challenges that I do see is the risk of an economic downturn, or the cyclicality risks. And this is basically inherent in the travel industry. If there is an economic downturn, people will travel a lot less. They will reserve so many less holidays. They will try to save up, and instead of using Booking, for example, just stay where they are, enjoy their vacation in their hometowns, or do less expensive trips. And now, before we move on to the investment conclusion, please remember that I'm not a financial advisor and this is not financial advice. So please do your own due diligence. However, I do believe that this is a very good company which has a very strong competitive advantage. It provides consistent, predictable, and growing cash flows, and they have high return on capital employed, the meaning that they can create value for the investor. So this is a good company and it may be a great investment. However, I would do more research on the negative equity before purchasing the stock, because it could be a red flag. So thank you for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.